Let's go ahead and dive in. First off, hello, welcome. Thank you so much for being here tonight. I know we spend long days on the computer now, so we appreciate you sharing a little bit more of your time with us tonight and hope that you'll find this information valuable and helpful. I want to thank our friends at Canvas Credit Union and Nancy who make this series possible. So if you are here to learn about your credit score tonight, or credit scores in general, you are in the right place. And it's perfect timing because I think our next workshop after this is home buying, which I know credit scores can influence home buying. So hopefully what you get out of tonight will help you continue your financial journey. I also want to do a huge thank you to our CSU Alumni Association members. Your membership really does make all of our events and programming possible. So if you're a member, honestly, truly, fully thank you for making this programming possible. And if you're not a member, that is a-okay too. I am more than happy to talk membership all day. And if you would like information on it, please just send me a chat. We also have CSU Day of Giving coming up on the 6th and 7th. So it's a 24-hour giving day for friends, students, alums. It doesn't matter who you are, and membership is included in that. So if you're kind of teetering on the edge of membership, it's a great day to dive fully into that. And again, feel free to chat me if you're interested, and I am happy to share more information. Just to reiterate for those who haven't heard me say it, we are in webinar format tonight. So that means your video and sound will be off the entire time. So if you have kids with you or pets or are doing the work from home thing in all of its glory, you're doing it right. And don't worry, we're not going to surprise you on video, but we do encourage you to use the chat, send us any questions. Any questions you put in the chat, we will remain anonymous. Nancy and I will see your name, but we won't read it to anyone. Just want to reassure you because I know financial stuff can sometimes be finicky that way. And then all of our polls tonight are anonymous too. Nancy and I won't even see your name for that. So if you want to take some wild guesses on those, please feel free to do so. With that, though, I know you all didn't come here to hear me talk, so I would love to turn it over to Nancy Patton. She is a CSU alumna and leads most of our Young Alumni series. She is an expert in anything and everything, and I do encourage you to throw all the questions her way tonight. And she's going to hop into credit scores for us. So Nancy, thanks so much for your time tonight.
Thanks, Alexa. Alexandra. Oh my goodness. And that was on video. How horrible. Thank you, Alexandra.
It's a long name problem. Don't even worry about it.
Good evening, everyone. Welcome to our class about credit scores. I'm Nancy Patton. I should have messed that up to even things out. I am with Canvas Credit Union. The topic of credit scores is one that has a lot of myth and misinformation around it. So we really want to encourage you to use chat to ask questions or request clarification as we go. We will be taking a couple polls, but they're anonymous. Nobody can see how you've answered. And then we'll be sharing the PowerPoint slides afterwards. We usually do that with an evaluation that goes out. The slides go out. Some other resources, we'll be sure to share some links. And then this is being recorded as well, and they post that on the alumni website. So lots of different ways to get some follow-up to what is actually presented during the session. So this is what we're going to talk about tonight. Some basics about credit scores, just to understand general things about how they work. We will talk about what is and isn't part of the scoring system. We're going to talk about some actions that impact your score. So what do you do and what impact does that have on your score? And then we'll make sure you got specific tips, very specific things you can do to manage your score. Finally, we'll cover how to get your reports and scores, because that can also be confusing, and we just want to be sure it's very clear how you go about getting both your credit reports and your credit scores. So before we actually start on the basics, I want to take a poll. And Alexandra, I think you're in charge of launching. So A couple questions to get us started tonight.
And we will give you all about a minute to answer this. We already have some great questions rolling into the chat. So Nancy, I'll just kind of hold on to those and bombard you with them when we get to that point. But thanks for those of you who just eagerly jumped in. It
Yeah,
looks like about
so much better when everybody participates. So thanks.
We have about 75% of you who have voted. We'll give it another 15 seconds. So if you want to get your vote in, do it in 10, 9, 8, 7, 6, 5, 4, 3, 2, 1. Let's share these.
Oh, we have a pretty smart group tonight. Okay. Yeah, the average credit score right now is 711. And interestingly enough, as far as I'm concerned, the scores have risen consistently over the last 10 years. So they're up about 20 points over the last 10 years, the average score. So that's good news, I guess. And then income is not part of the credit score calculation. So I should clarify that if you ask for a loan, people are going to care very much about your income. But if we're strictly looking at how your score is determined, then income is not part of that. So I think we're ready to move on and dive in to some general information about credit scores. Credit scores predict how likely you are to repay a loan. A low score is a higher risk of repayment. So scores are built on the information reported to the credit bureaus, and those bureaus are listed there. There's 3 major credit bureaus. And the information changes all the time. So how does information get to a bureau? Well, here's how that works. You do something related to credit. You might open a credit card, or you might close a credit card, or you make a payment on one of your loans. So you do something with your lender, and the lender reports to the bureaus once a month about the actions that you've taken. So that information keeps reporting over time. You do things, your lender reports to the bureaus what you've done regarding your loans, and that information keeps building up until somebody says, hey, I'd like to know what their score is. At that point, they pull your credit. The information is run through scoring formulas, and there's your score. So your actions with a lender, like opening a new loan, paying off a credit card, or being late with a payment, are reported each month. Information builds over time until the information is requested. It's run through the formulas, there's your score. And because that information at the bureau is constantly updated, your score changes all the time. Now, most people's scores remain relatively stable, changing probably less than 20 points in a 3-month period. You've probably heard of Fico scores. They are the most commonly used credit score by people who are going to do loans. Lenders look at Fico scores. FICO stands for the Fair Isaac Corporation. It was actually started by Mr. Fair and Mr. Isaac way back in 1956. And then their formulas, this credit scoring system, has been in use for more than 30 years. Here's a few other facts about credit scores. Not only do they change, but there are multiple versions of scoring systems, and there are multiple versions of FICO scores. Companies want to use a version that specializes in predicting the risk for what they are lending money for. So if they're primarily auto loan lenders, they're going to use a version that's proven really accurate about auto loan risk. Same thing for credit cards or mortgages. There's a version of FICO scoring that's targeted to certain industries. So there are also versions that get updated and released just because of what's going on in the economy or the financial climate. So for instance, there are some newer versions of FICO scores that handle medical collections differently than the previous versions did. So it's kind of like an operating system on your phone or your PC that gets updated. It means that there's some new information or some issue that's been found since the last version was out. So they offer a new version. With the credit scoring options, lenders can pick whatever version fits their needs the best. So depending on the lender, they'll use one version or a different one, and it varies by lender. In general, FICO scores range from 300 to 850, with the average score right now being 711. Oh, I didn't update my slide. I updated my notes, but not my slide. And you can see the change. You can see that it's growing. It was 706 before. Anyway, yeah, gradual change of, in spite of the pandemic, in spite of the recession, we have seen credit scores average numbers go up. So you certainly don't need a perfect score to get great lending. In general, they say that a score of 740 and above means you're going to get a great rate, great interest rate. You're going to get great terms on the loans you take out. If your score is below 600, then you start to have more challenges getting credit. It's going to be more expensive. You probably have to go through more information that you submit in order to get a loan. And you should know that credit scores are a purchased product. So a lender pays the bureau to see your score. Okay, couple other things about general stuff. Alexandra, do we want to touch on
I was gonna
anything?
say, I have a couple of questions that I think are relevant for you right now. So out of curiosity, how are these averages determined?
You know, they, again, like that source was Experian, I think that the 7-Eleven came from. So there's a lot of interest in credit scores, and various companies and the bureaus themselves will run those numbers and share those updates. Pretty much every year, you can just Google average credit score and see how it's changed, what's come out. I know my FICO does some work around that. And then I think each bureau does some information around the average credit score.
And then also a related question is, what are some of the factors that you think have made the averages go up over the last couple of years?
So a couple of things. The pandemic, you know, impacted people differently. And we all know that. But if you think about it, the savings rate went up. There were a ton of people in the pandemic who actually set aside more money, saved more money. And in general, that means they're behaving more conservatively. So they're taking really good care of their finances, including their credit. The other thing we've seen at the credit union is that people are paying down their loans. Those who have been, in general, through the pandemic in a relatively strong financial position are actually using some of the stimulus money or some extra savings because they're not traveling. They're using this money to pay down debt. And often that has an impact on your credit score. And honestly, there was a rise as well after the recession. So 2009, 2010, I think it was a little bit of a wake-up call, and people said, you know, I just need to be more careful. In that recession, the credit card companies actually punished consumers, and by raising rates, turning off credit. And I think people said, you know what, I'm not going to be in that position again. And so all of those behaviors have contributed to better scores.
Thank you. Out of curiosity, are credit companies still like punishing people this time around?
No, I'm not seeing it. Now, I can't say that flat out, but in general, this crisis has been very different. And I have not heard of that behavior.
Okay. And then this is we're switching lanes a little bit, so this may fall later, but how does getting married alter your credit score, or does it alter your credit score?
Be paid, so they stopped you from using your credit card. Basically, they cut off your limit, they shut down your card, they raised your interest rate. They basically punished you, hoping to have you stop using it because they weren't sure you were going to get paid. They were going to get paid back. And we just have not seen that behavior this time.
Perfect. And then I apologize. I think my internet cut out a little bit, so sorry if this is choppy. The question, switching lanes a little bit, is how does getting married affect your credit score, or does it affect your credit score?
So it doesn't. That's a great question. Your credit is individual. Now, if you borrow together, two of you go on a loan together, and one of you misbehaves and doesn't pay, it will hurt the other person. But all of that information is reported individually per person. And the only way that situation would happen, and it could be to the good, two of you could be on a loan and someone is making the payment, you're really not involved, but you're on the loan, and that's helping you. But in general, your credit is your credit. It reports under your social, and you do want to be careful with anything you do joint loans. Yeah.
And then I think a follow-up to the last question is, if income is not a part of your credit score, why is savings? Because isn't savings connected to income?
Nope, savings is not part of your credit score either. So we will cover what's in the score and what's on the report, because sometimes things are listed on the report and they don't impact your score. So we'll talk through all that in a second.
Perfect. You all are firing some really great questions here. I like this one a lot too. Do you know if the eviction freezes during the pandemic are contributing or will contribute once freezes are removed, either positively or negatively to increasing the average credit score?
So there's some discussion about, again, this crisis is very different. So rent evictions, rent non-payment would not affect your credit score because rent is not a loan. So rental history doesn't contribute to your credit score situation. The mortgage situation, you know, they've done a lot of forbearance, they've done some things, some forgiveness and stuff, but in general, they are predicting there may be a slight bump in people who are going to go into foreclosure or who will not be paying their mortgages, but they do not expect that to be a big number. The general prediction is that it will have nowhere near the impact of the previous recession, and that basically we're not going to launch into a fix and flip situation where everybody can grab a foreclosed house short sale and turn it around. They just aren't expecting that.
Perfect. Really great questions. Thank you all for using the chat for those. I think we are through this first round, but again, keep them coming and we'll keep asking them.
Yeah, I love it. Just love it. Okay, so everybody knows it's helpful to have a good credit score. And most people think about the fact that it's going to affect their interest rate on a loan. And so here's a slide that just talks about the true impact of a credit score that's 100 points apart and a car loan of $30,000. These are very realistic numbers. these interest rates for these credit scores. And if you look at this, this is one vehicle loan. The difference in expense to you is more than $10,000. So just a very vivid example. And then, you know, even looking not just at the big picture of 10,000, but look at the difference in monthly payment. What an impact on your life on a monthly basis this kind of thing has. So here is just one example of how credit score influences your lending interest rate and what an impact it can have on your financial life. Credit scores actually affect a lot of other things in your financial life too, not just credit scores or not just interest rates. So one of the things that influences how much you pay for auto insurance, home insurance, mortgage insurance is your credit score. And so there's, again, something we all tend to get, auto insurance, and your credit score actually influences how much that's going to cost you. Landlords often look at credit scores or credit reports before renting out an apartment. And your utility deposits can be influenced by what your credit score is. I know of utility companies where if your score is here and above, you pay no deposit. If your score is below that, you have to pay a deposit. That's right on top of all the other costs that go with a move. And so it's a really horrible time to be having to cough up extra money just so you can turn your electricity on. When you get a cell phone, when you open a bank account, and if for anybody who's interested in the military, your military clearance, all of those things are impacted by what people see on that credit report, credit score. Finally, there's some misinformation sometimes about employers looking at credit. So first of all, yes, employers can check your credit as part of an application for employment. They have to inform you of that. You have to sign off and say, yes, that's okay. They will not see your score. What they will see is a report, and what they're looking for is risky behavior, you're maxed out. The same thing applies to the military clearance thing. It looks like you could be a security risk because of how you're handling your finances. So in Colorado, only certain employers can look at your credit for a hiring decision. But like in our business with finance and with insurance, those kind of occupations, absolutely looking at credit is part of the employment process, hiring process. All right, so there's all kinds of reasons to consider what's going on in your credit world. Looks like we have a question.
I do have a question for you. When employers look at your credit, do they just see the snapshot of where your credit's at right now, or do they see the history of your credit as well?
A credit report, although the score is a moment in time, a snapshot click, your history on your report usually goes back at least 2 years. So for instance, when you look at your report and you have a credit card, it will list basically, were you on time or were you late for 2 years? And the same thing with your auto loan, whatever. And so they would be able to see, oh, they have a history of skipping payments, or look, one time they messed up, no big deal. Yeah, that's what your report looks like.
Awesome, thank you.
All righty. Let's jump into what was sort of hinted at before, which is what is and isn't part of your score. So first of all, let's just talk about the report. You get a report. It's a bunch of pages of information about what you and your lenders have been doing. There are some things that just don't even appear. There will never be anything about age, gender, religion, marital status, job title, income, none of those things are anywhere near there. Oh, and I said age, but your age does appear on the report. So I'm sorry, I didn't say that right. Read that column of things that do not appear. Okay, then if we shift over, there are some things that do appear. So it may list who your employer is, your name and different names you've had, and if anybody ever typed your name into the system incorrectly. So my name is Nancy Patton, but I show an alias of Nancy Patton because at one point somebody typed into the system that my name was Nancy Patton. So those things appear on the report, but they are not associated with your score. There is zero impact on your score by any of those things. Okay, so if you were looking at your report, what you would and wouldn't see. Well, here's what does matter. Here are the things that do show up on your report, okay? You'll notice that, or these things do impact your score. You'll notice that some things impact your score more than others. And we're gonna look at each one of these, but before we go too far, we're gonna take another poll because what's the fun of not having some polls going here? So, yep, we're about to dive into some actions and the scoring system, the different things that impact the score. So I've got a couple questions for you about your behaviors.
And again, we'll give you about a minute to answer it. Take your best guess. It's anonymous, so if you get it wrong, no one knows. I will say, because we have this fun early view, right now it's about split 3 ways. So it'll be fun to see how this plays out.
All right.
Give you about 20 more seconds. Once we hit that minute mark, we will share it out. So if you haven't answered, answer in the next 10 or so seconds. Take your wildest guess. I'm embarrassed to admit I have sat through this class before and probably should be able to answer number 1, but I'm excited to see the answer. All right, let me share this with y'all. There we go.
All right. Yeah, so, and the winner is a late payment on a mortgage. Out of all those actions listed there, the thing that would hurt your score the most is a late payment on a mortgage. And late payments are probably going to hurt you more than opening or closing cards in general. So paying your credit card balance in full each month will help your score. That is false. Now, it will help your financial life because you won't pay interest on your credit card. But the way the scoring system is set up, you don't get extra points for paying your full balance every month. So we'll talk about that more when we talk about the your use of credit. But in general, it's certainly a great practice to pay off your full balance every month if you possibly can, but that isn't how your score gets determined. So let's dive into, I'm about to talk about each of these aspects of your credit score, and I just want to clarify something. I need a little bit of grace here because these scoring systems are very complex. So I'm going to say things like you'll probably lose 5 points. You'll probably lose 60 points. And I just need to stress that these are complex secret formulas. And so you need to give me a little grace. It might be 6 points or 7 points or 4 points, not 5. And if you would just know that these are approximate things regarding the scoring. It is proprietary. They do not share extensive details about this. So, all right, here we go. Biggest factor that's going to influence your score is if you make loan payments on time. So when I talked about the credit card and paying off your balance, it doesn't care if you pay off your balance. What it cares is if you pay on time. That's the biggest impact to your score. Are you paying on time? So our research shows that your score could drop 60 points if you have a 30-day late payment. And that being late on a mortgage could be even bigger than that 60-point drop. So life happens, we get things happen and we miss a payment or at some point, but getting caught up as quickly as possible is going to be the best thing to help your score. Some of your points will come back as soon as you get caught up. It's going to take a year or so for the rest of the points to drift back in. But your thing is you want to get caught up as quickly as you can if you do in fact miss a payment and are 30 days late. If you run 60 days late, that's really going to start hurting your score. So for those of you who don't have many loans, you may decide that you want to do something to help your score by having other payments contribute to the scoring system. So I'm not going to recommend this for everybody, and I need you to do your own research and see if this is something you want to do. But there's a couple companies listed there, a couple programs. One's Rental Karma and one's Experian Boost. And they have the ability to, on at least one bureau, report rent or some other kinds of payments and have it contribute to your credit score. Sometimes there's a fee for this service. You need to do your research. I'm not blanket suggesting this for everyone. But we do get the question about, I just don't have a lot of loans. What can I do? Okay, so that is one way. And if you want some other ways to get started with credit, please put that into chat and we will talk about some other ways to get started. So keep in mind the impact to your score in this category. So we talked about being on time and late. It's based on how often you're late, how recently you were late, and how big the dollar figure was. So let's give an example of if you had one late payment a couple years ago and it was a small bill, that's hardly any impact on your score. But it just last month, if you were late and it was a big car payment, and in fact, you'd been late a couple times recently, that's going to have a much bigger impact on your score. So how often, how big the dollar figure is, and how recent, those all impact the intensity of the score drop. And did we have a question? Because I'm missing something on here that I want to say, and I can't think of what it is.
Well, I have a couple of questions for you, but I'll let you jump in and finish your
Yes, I finally remembered this. What happens if you're like 10 days late on a payment? So most companies are going to have a late fee, or they're going to start making some phone calls to you saying, hey, where's my money? But a late payment doesn't impact your credit score until it's 30 days late. So 30 days late is that's the cutoff point for when it starts to hurt your credit. Okay, question.
I have a couple, and I have a feeling you're going to answer them at some point in this presentation, but I'm going to throw them at you now. So the first one is, if paying it off in full doesn't help, so like your paying off your debt in full doesn't help it, wouldn't it go into the debt slice of that pie chart you just showed a minute ago? And then isn't having continuous like growing debt an issue?
So it's interesting. Continuous growing debt really isn't a problem, but yes, you're correct about it'll spill over into the next category. So we will talk about that in just a second. But as far as the impact of the scoring system and you paid in full that month, it's really not part of the deal.
Cool.
Nah.
I think you're going to
Okay, are
touch
you
on
ready for
this
the,
one. Oh, no,
oh,
we
no,
got a few more. Can't jump
okay.
ahead too quickly. Although I do think you'll probably touch on this one as well. So if late payments hurt your score, is there things you can do in your payment history besides being on time to help your score?
No. So the biggest thing is if you have a mistake, if you miss a payment, get caught up as quick as you can and try to minimize that. When we talk about very specific tips at the end, we'll have some other ideas maybe that would help avoid that happening. But no, a lot of this stuff, it's not like you can say sorry and do extra credit.
It's like a crappy class.
Yeah.
Just kidding.
Yeah.
Not saying classes without extra credit are crappy, but credit scores, they get me. The last question we have for you is, do bank overdraft fees impact credit?
No, because that's not a loan. Now, if you didn't pay your overdraft loan, then that would, but insufficient funds fee is not a loan and it is not part of the scoring system.
Perfect. Thank you all for the questions, and thanks, Nancy, for answering them.
All righty, let's jump into this one. Okay, this one is 30% of your score. It's the next biggest thing. And I think it can be confusing. And some of you have already picked up on some of the questions and some of the angles that make it confusing. So let's talk through how much do you owe, the chunk of the pie that is about how much you borrowed, 30% of your score. The formulas are going to consider your total amount of debt, and they're going to consider how many accounts you have that have a balance on them. And if it's been a while since you thought about how loans work, we're going to talk about two kinds of loans, revolving and installment. So let's do a little review of how those work. On this part of the scoring system, when we're talking about installment loans, it cares about how much have you paid off. So installment loans are like a car loan. It's paid in equal installments. So we know when the loan starts and when it stops. We know how much you're going to pay each month, when that payment is due, and it should be the same payment all the time. So that's an installment loan. And this part of the scoring system cares about, did you just take that loan out? Was a $30,000 car loan and you still owe $29,900 on it? That impacts your score more than if that $30,000 loan is 5 years old and you've paid down a bunch of it already. Okay, so in this part of the scoring system, that's how it looks at installment loans. Then there is revolving loans. And if you think about revolving, it changes, it rolls around. Every month it looks different. So a line of credit or a credit card are revolving loans, and those change all the time. I don't know, I gave you a credit card. It's for $1,000, but I don't know if you're going to use $10 or $999. And I don't know if you're going to do it the next month the same way. So you see how there's variability and unpredictability. And basically it's always there. It doesn't start and stop. Once we give it to you, it just stays there. Okay. So with revolving loans, this part of the scoring system is concerned about how much are you using out of how much you've been approved for. So if you were approved for $1,000 and you're only using 100 of it on this loan, that's not a big deal. If you were approved for $1,000 and you're using $999, now you're maxed out. We're a little uncomfortable as a lender. And so your credit score drops. All right, so you've probably heard that you should use 25% of your available limit. So if you had a $1,000 limit and you used up to $250 of it, not a big deal. And this is where the paying in full every month would be helpful to you Because if you had $250 on there and you paid it down and had nothing, now that's great. But what gets reported to the Bureau is what's on your statement. So if every month you have $999 on there and you pay it off in full, that's awesome that you're paying it in full. But every month it looks like you're maxed out. And so the scoring system is going to say, this is risky behavior, let's drop their score.
It's almost
Okay,
like
sense of question.
a whole nother language you have to learn to speak. I have a couple of really good questions for you. So this one is in regards to student loan repayment. And because it's into student loan repayment, before I ask Nancy, I will put a plug in that our next Young Alumni Workshop on August 11th is on student loans. So if that's of interest, I hope you join us for that as well. But it says lots of different repayments, but it's an installment. So how does that factor into the credit score?
Student loans are just like any other loan. If you pay them on time, that's awesome. If you're late, 30 days late, it's going to ding your score. They're treated just like any standard loan. Same things apply.
And then this next question is in regards to car loans, and it's, could you pay your monthly car loan with a credit card? And if yes, and you pay with your credit card on time, is this sort of like a double count, double impact on your credit score, but in a positive way? I like the thinking of
Someone's being very creative. In general, you're not supposed to pay credit with credit. So if you were going to try to make your car loan with a credit card, I think you would have to do it through an advance, and that is extremely expensive. Really, really, really expensive. So unless there's some other system where you're doing that and then you're getting like mileage rewards for your credit card payment on there. In general, we don't want to pay loans with loans. If you're there's some gray area there. With online payments, I suppose you just put in the number, huh? Somebody's working that system.
I know, I'm like, that's a tricky one, but if that works, let me know, because I would love that.
So, and then the only risk is if for any reason you can't pay that credit card in full that month, now you've added interest payment on the fact that you're paying interest on your car loan. So I know there are a couple people from Canvas on the call. If anybody has greater insight into why that one just sounds really scary to me, if anybody can clarify that in better words, go ahead and put that in the chat.
And I will say often attendees learn from one another. So if we're reading these questions and you have some great financial tips or tricks, do feel free to chat to all attendees. We always love hearing your expertise as well. A couple more for you, Nancy. We're just gonna keep them coming. Does any IRS debt that is being paid according to agreement impact credit score?
IRS tax liens do show up on your credit, and they have a very strong negative impact. I am not certain if you're paying. If you're paying as agreed, I honestly don't know the answer to that, because that's really not a loan. So it seems like even though you're paying as agreed, until it's cleaned up, it's going to stay there. Once it's cleaned up and removed, that would help your score dramatically. But I will confess, I cannot say for certain. Wow.
I know, these are some good questions. I'm like, you all are really keeping us on our toes tonight. Thank you. And then before we move on, I have one more. It's, if you pay off your credit cards in full multiple times a month, how does the total amount used, loaned add up in terms of maxing out a card?
So again, what's going to report to the Bureau is what your statement says. So if you use your card and you make advance payments before your statement shows up, then your statement will reflect the fact that you've made those payments, and it will show just whatever the remaining balance is. So if for you, that's a way to manage it, that's fine. For most of us, life is too complicated and we don't want to go through all of that. If you can, we'll have some tricks that you can do to raise your limit so that your spending doesn't fall into danger category on capacity. But in general, I don't want to micromanage my money that closely. I want to pay my bill when it shows up. And so I've raised my limits so that I can spend and stay comfortable. Now, not everyone can handle that. So you have to know yourself and know what's my risk factor. If I give myself more credit, am I going to go crazy and use it all? Then please don't do that. So you have to know yourself and what are your triggers. And if paying it, you know, the next day after you put it on the credit card is how you need to manage your money, go for it.
And I will add into that one because I am the type that probably pays it off multiple times a month. We did a budgeting workshop at the beginning of this year. Our full Young Alumni series, they're all recorded and on the CSU Alumni Association's YouTube channel, as are all Alumni Association events for you all to access. But the budgeting one specifically, I think, has some good tips and takeaways, and I'll pop that in the chat here momentarily too. So if you're someone who needs to think about at what points of the month bills are coming due or when you're paying things, I think Nancy made some really good points during that workshop as well.
Cool. All right. We're going to get through this here. We have covered the big two. These are the biggest things. Are you maxing out your revolving credit? And did you pay on time? Those are the biggest deals. The other thing we have to touch on this slide is, do you have revolving credit? There appears to be in the scoring system just a limit to how many points you can get if you never have a revolving account. And so if you are someone who is violently opposed to credit cards, that's fabulous, that's awesome, no worries. But you may consider opening like a line of credit on your checking account, an overdraft line of credit. It will do the same thing in the scoring system. It will be a revolving account and it will help you maximize your score, but you don't have to have a credit card. So, so that's just for those of you who are aiming for those really high scores. It appears that you need to have a revolving account of some kind. All righty. Next part of your score is just 15%, but it's how long have you been in the system? So your score is higher if you've been in the system a long time. And so this is one reason why closing credit cards can drop your score, because it means that either your average age is going to be affected, or maybe that was your oldest account. So different kinds of how long have you been in the system questions here are part of the formula. What's the average age? What's the newest? What's the oldest? And this one's pretty straightforward though. You get more points for being in the system a long time. Okay, we're going to launch poll number 3. And we just have one more part of the scoring system to talk about. So I want to ask just a couple of questions.
And while folks answer that, Nancy, back to the previous slide, another question is, at what percent of the max credit is considered a danger, or like is a dangerous level as seen by lenders?
So maxed out completely, absolutely. It used to be the formulas appeared in the past to do a direct relationship. The more you used it, the greater the drop. And then they seem to, maybe 5 years ago, that changed a little bit. So The general advice we see all the time consistently is 25% of your limit will not impact your score in any strong way. So again, the $1,000 limit, using $250 of it just shouldn't have hardly any impact at all. And again, most of us are trying to live our lives and keep our sanity. And if you find that you are consistently close to maxing out your limit, we may want to look at some other tactics.
Perfect. Thank you. And then we'll give you all about 10 more seconds to vote here, and I will share the results. Let's say 3.
All right, and it's question number 2 that was my newest bit of knowledge recently. So,
all right.
All right.
Shared.
So pre-approved credit card offers do not hurt your score. You are correct. So a credit card company has looked at your information and said, we'd like to do business with this person. I'm going to offer them a credit card. But that has not hurt your score. That has not been an inquiry, a hard inquiry. That has not hurt your score. Now, if you take advantage of the credit card offer, then we're talking a different situation. And then which is larger, the number of people with no score or those with a score over 800? They're about the same. It's about 20% of the population that either have so little information or it's been so long since they've used credit that they are no longer generating a score, and the people who are above 800. So it's about 20% of the population for each of them. About 20%. Okay. We'll stop asking you all the hard questions and you keep the hard questions coming to me. But here's another aspect of the scoring system where there are some myths. So we're going to look at the 2 actions. This is 10% of your score. It's called new credit. And it has 2 things going on. One is inquiry. And the second part of it is new credit. Okay. So inquiries are when someone looks at your score to see if they want to lend to you. There are a lot of times where looking at the report does not impact your score. You can look. You could look 5 times a day. You can look and it doesn't hurt your own score. An insurance company or an employer, those don't hurt your score. If you get that credit card offer in the mail, that hasn't hurt your score. If you ask a lender to pull your credit so that you can get a loan, that's going to impact your score. So I'm out shopping. At checkout, they say, hey, you could save 10% on your purchase today if you open a credit card with us. And I say, sure, go ahead. So they do an inquiry. And my score is probably going to drop about 5 points. And the way the system works, those 5 points are off my score for a year. It just, the impact that it has stays for 12 months. If I proceed and open the account, they say, yes, you qualify, open the account. And I open my new credit card with that store. Now I have a new credit line and I've lost an additional 10 points also for 12 months. So if I'm out shopping at Kohl's and I get, I don't know, towels, but I save, $8 because I opened a new credit card, I've lost 15 points off my score for a year. And where this really starts to add up is on the way home, I stop at Target and I do the same thing, or I stop at Best Buy, or I love to use the example of I'm going to buy my guy some bling, so I go to Zales. But every single time, if it's 5 points for an inquiry and 10 points for a new line, I've lost 15 points every time I open something up. So we are always going to encourage you to get the credit you need. Do you need a car? Please go get a car loan. Are you going to get a mortgage? That's amazing. What a wonderful adventure. Some of us need an RV or a boat. I don't know, but get the credit you need Don't open a bunch of stuff you don't need. So think about that scoring and that impact. And I just really want people to be aware of how casually opening credit can have a big impact. So we also get asked a lot about, a car loan where you know that multiple lenders are going to look at your score. As long as those credit pulls happen within like a 2-week period, it only impacts your score as if it was one. So the system has accommodated for the fact that you are car shopping. Lots of people are looking at your credit, but you're in all likelihood buying one car. And so it's one inquiry in the damages to your score. Okay. So I just want to give that one a second. Did we have anything come in on that? Usually that one gets a few questions.
I know I was ready. We don't have any questions yet, although feel free to pop them in the chat. One we had that I think was the last time we did this credit scores workshop that I thought was interesting is around home buying. If you're looking at multiple lenders, is it 5 points per lender that pulls your score?
No, it's the same deal. So it actually applies to student loans, mortgages, and auto loans. The scoring system has figured out that these are all related.
Mm-hmm.
Now, I used to work in the car industry, and we had a guy that would sell 2 cars every time. I don't know how he did it, but Wes would sell 2 cars. And so the customer was getting a real break on their credit score because we'd pull their credit and then we'd sell them 2 car loans. But for the most part, people, if you're shopping for a car, you're getting 1 car.
Mm-hmm. I was gonna say, I don't know if that's how he did it, but it probably wouldn't be enough to sell me on multiple cars. Maybe someday.
I don't know. Wes was the double deal guy.
Some of us will have our magic. That might have been his. Another question is, why does it impact your score if you don't get approved?
Oh, because you were shopping for credit. And so if you think about it from a lender perspective, and that's really what these scores are about, they're geared to help lenders. If you're asking for credit, that's a risky behavior. And particularly credit, you don't need those credit card things and stuff. But yeah, anytime you're asking for credit, there's risk. It's a risk predictor.
Good question. I think we're good to keep moving on too.
All right. Here's the last. Oh, I lied. There were 2 things that we had to talk about. Here's the last one that is part of your score. 10% of your score is the mix that you have. And basically, the scoring system wants to see that you can handle different kinds of credit. We talked about installment and revolving. It wants to see that you can handle different kinds of things well. It likes mortgages. I would certainly never suggest you go get a mortgage so you can raise your credit score, but it does like to see a mixture of kinds of lending and that you're handling all of them well. Okay, that's the different parts of the scoring system. So I'm going to launch into some specific tips, and we've kind of hinted at these along the way. The biggest part of your score was impacted by being on time with your payments. So do you need to set up auto pay? Probably the easiest way to make sure you have an on-time payment, assuming you have the money in your account. And then sometimes you can just ask for a different due date. If your auto loan comes the day before your payday, ask your lender, hey, it would just really help me out. Or you need to build a slush fund, or you need to do something so that you can have the money there for the on-time payment. But it's fine to ask your lender if you can switch up the due date. For your revolving debt, like those credit cards, only using a small percentage, say 25% of what you've been approved for. The other option would be to open another credit card so that you had more capacity to work with. Again, you have to know yourself, and is this just going to be a risky behavior that's going to get you in trouble? You can also ask your current credit card company to raise your limit. And a lot of times people get asked, hey, we want to raise your limit. And they think, no, I don't want that. Well, if it's risky for you, that is correct. But if it's not risky for you, it will help you in this capacity category to have the company choose to raise your limit. So keep that in mind. Another thing we see that's really helpful is restructuring debt. So this doesn't make debt go away immediately, but it puts it into a different category. The most common thing is to take credit card debt and change it into an auto loan. So if you have equity, if you have ownership in a vehicle, and you have credit card debt, we can pay off the credit card and give you an auto loan. Okay, so this is kind of a concept. You have to think through this one. So you had $5,000 of credit card debt, but you own your auto and it's worth $10,000. We can create a $5,000 car loan, pay off your credit card, and now you have a couple things going on. You've improved your capacity because you got rid of your credit card debt. You've improved your mix of credit. We're going to give you a whole lot of hope that you can get out of debt quicker because the interest rate on the car is so much lower than the interest rate on your credit card. It's going to save you money because that interest rate is lower. And in a lot of cases, we can reduce the monthly payment. Or you can keep making the same amount of monthly payment and be out of debt way soon. So this is a great tactic if credit card debt has you really frustrated and it feels like you can never get ahead. Changing it into an auto loan or a home loan is one way to do that. It's restructured what your debt looks like. Okay. Again, we mentioned a revolving account, having a revolving account, and keeping your credit cards open instead of closing them, unless it's a risk, a fraud risk, unless it's a financial risk for you to have that credit available, then it's always close them, get them out of there. But if you don't feel it's at risk, leave them open for the benefit of your score. And then only opening new credit when you need it. Too many inquiries, too many accounts, those things drop your score. Okay. I'm sensing questions before we get to that last part that talks about scores or reports. Yeah.
Perfect. I think this, you may have already answered it, but I'm going to ask it because it's slightly different. So in regards to the keeping cards open line, would it do more harm than good to clean up your revolving lines by closing one or two of those retail store credit cards if you're trying to improve your score?
So it'll ding you in the capacity category and it'll ding you in the account history category. So you have to know yourself. What are you trying to accomplish? If it's any danger in any way for you to have those cards open, oh my gosh, it's not worth the points. Get rid of them. Clean it up. You just want to simplify your life. It's worth it. Get rid of it. If it's not any big harm, it does help a couple of categories of the scoring system to have those things stay open.
Perfect. And then why a car loan instead of debt consolidation loan to get rid of credit card debt?
So most debt consolidation loans are going to be at a higher interest rate. It's a personal loan. It's not tied to collateral. A vehicle as collateral. And so again, credit card interest rates, personal loan interest rates, those are just signature. That's the only thing that's the security for the loan. If we do a car loan and things go sideways, we can come and get the car. And nobody really wants that, but it does lower the risk. Therefore, it lowers the interest rate on the loan. And a lot of people do like a home equity loan or something like that if they have a larger amount of credit card debt. And the only consideration on that is that there can be fees. You have to do your research and find the lowest fees that are possible. Whereas with an auto loan, the fee is $17.20 to do a lien filing on the title. So usually much cheaper than home loans.
And then next question is, if your current credit card company offers to increase your limit, will there be a hard inquiry hit of 5 points to your score?
There might be the 5 points. It shouldn't be the 10 because you don't have anything new. But yes, it might be the 5 points to do that. Or they may have simply done a soft inquiry, liked what they saw, and will bump the limit. But most of the time, you're going to overcome those 5 points with the extra benefit you get from the increased capacity.
And then is this the same? I assume it is the same if you're the one making the inquiry versus your credit company offering it to you?
No, you can look at, so an inquiry means somebody's asking, looking at your score. You can look at your score and it has no impact.
Perfect. And then back to cars. If your spouse purchases a car after you have purchased a car recently, will that impact your credit score?
Depends on who's on the loan. Was it your loan all by yourself and their loan all by themselves? That's individual credit, has nothing to do with the two of you. If you're both on both loans, now you will both be impacted by the fact that that's inquiries, it's on the report, it's a new line. Yep.
Perfect. Great questions, friends. I think we
Yeah.
made it through this round, but keep them coming.
So we're going to talk about how to get your reports and how to get your scores. I do have to say these are the best questions ever in a credit score class, no doubt about it.
CSU alumni, y'all are amazing, and our friends at Canvas, of course.
So how do you get your reports? This only safe place to go is annualcreditreport.com. This is required by law. The bureaus have to have this site available. You can get all your reports there, your Experian, TransUnion, and your Equifax report by starting at Annual Credit Report. If you have never looked at your reports, it's amazing how many reports have errors. So we do encourage you to look at your reports. In general, you can spread them out. Normally we get one per year from each bureau for free. Great news. Thank you, COVID. We can now check our credit reports once a week until April of 2022. So you have a whole year, 52 opportunities to check all your reports. I don't know why you would want to do that, why you would want to go through that brain damage. But there are a couple things. By looking at reports, you're looking for errors that could be fixed because humans are involved in that. I told you this, my name is Nancy Patton on a report. It's going to be there forever because somebody, human error, put it in that way. So errors do happen and you should look and see if there's a problem. It's also a great way to watch for identity theft to see if anything's happening that you didn't instigate. So that's your report. It's going to list all the things going on. You can download it and or you can print it off, restock your printer. It's a lot of pages, but basically it gives you a look at what's going on, but it's not your score. So let's talk about how to get a score. You can pay a small fee from any of the bureaus. You can go to My FICO and pay for your score. If you, in fact, are in the process of getting a loan, you can ask your lender to tell you your score. And many credit card companies, banks, credit unions now offer your credit score as a benefit. And so to be accurate, you should look for the FICO logo. Make sure that the score that they're offering you is a FICO score. If you don't care about getting a really accurate score, you just want a general idea of where you stand, you can use something like Credit Sesame or Credit Karma. They're safe. They'll ask you to buy things, so just probably don't need to buy anything. But it'll be an educational score, sometimes called a consumer score. It is not a true FICO score. It hasn't been run through the FICO scoring systems. But those are all some different ways you can get a score. I've just got a couple more things to share. One is that often when we're talking about credit scores, there are people who are looking for resources to help with their debt. And so there are lots of scams out there regarding debt repayment. And I just want to be sure that I'm sharing this information about GreenPath. It is a reliable, trustworthy nonprofit nationwide. And they really are an invaluable partner of many banks and credit unions. If you're a member of Canvas, you can use GreenPath for free. They have a wide variety of really valuable resources and education. Their website's full of good information. So I just want people to know about GreenPath if you're considering that you need some help with your debt levels. And then I do want to say thanks for being here. A good credit score really can help you afford life. Remember that $10,000 slide on one loan. And understanding how the scoring system works lets you be in control so that the actions you take can in fact save you a lot of time and money. That is, okay, what's hanging out waiting to be answered?
I was going to say, first off, a huge thank you to Nancy. You really do provide, I think, just the best material. Please do keep questions coming. I know we have a couple in the chat, which I'm going to fire off right now. And then I also put 2 links in the chat. The first is the survey for tonight. Just some quick feedback. If you have other topics you would like to see done, we've done budgeting, we've done home buying. I think we have home buying coming up. We have investing coming up. And then the second is the link to our Young Alumni website, where you can see recordings of past Young Alumni series events or register for future ones. So if you want to join us for home buying, student loans, or investing, I think those are the ones we have coming up. And then we did budgeting at the beginning of the year. But again, thank you for being here. I know we spend long days on the computer, and then in our last couple of minutes, feel free to throw any additional questions at us. The ones that we have hanging out for you, Nancy. Let's start with, when you look at some of these websites, does it ding your credit since it's accurate like a hard inquiry?
No, you would have to actually, in order, again, you looking at your score, you doing research, none of that's going to do that. If anything's going to impact your credit score, it means you're going to have to provide your social security number. You're going to have to give them permission to pull credit. Those are the things that are going to ding your score.
Perfect. And then the next question is, if you do see a problem on your credit report, so if you're looking through and seeing that problem, how soon do you need to report it? How do you go about reporting it? How do you fix that? Great question.
So errors on credit reports are very common. I've mentioned my name error. That one is not affecting my score in any way. It's not affecting anything, so I've never fixed it. It's not a big deal. An address that's wrong, anything like that, an employer that's wrong, none of that matters. If you have information that's reporting on the bureau that is the kind that's going to affect your credit score, the things to do are to go through the dispute process for each bureau. So the error that you see may only be on one bureau. It may not be on all of them, but you have to go through the dispute process every place that the error is. The dispute processes are similar, but you will need to go through whatever the process is for that bureau that has the wrong information. The good news is there are some timelines on that. They can't drag it out forever. They do have to take action, but they aren't going to just go, oh, okay, so you say this is fine, fixed. There will be some research. They will contact the lender. They may require you to contact the lender. just be aware that there is a very specific process through each bureau, and you'll do the corrections anywhere that the error happens.
Good question. Definitely an important one to know. I think those are all of the questions we have. I'm hoping I didn't miss any in the chat. But again, if I did, feel free to just flag it really quick. Want to say thank you all once more. Thank you to Canvas Credit Union and of course, Nancy. We have a really great comment that says, I've been thoroughly educated about credit so I can teach others about living within their means.
That's
Thank
awesome.
you, Nancy, and thanks to you all for joining us. I know I always enjoy these workshops as well. Have a wonderful night and go Rams.
Yeah, the day is coming where we might be able to be in the stadium saying "Go Rams."
Yes, we are exploring in-person options as well as the virtual component. So hopefully best of both worlds. But thank you all again and have a wonderful night.